2025 is going to go down as the year of the campaign of doom. Really, never has there been so much fear-mongering. Now, it's a culmination, really, of mounting prevalence of negative emotional stories. By the way, it's a 21st century phenomenon. You can see the rise in stories about anger, fear, disgust, and a marked decline of stories about joy. But this year, this particular year, the stock market news has been overwhelmingly negative. Constant stories of fear and doom. One day, somebody will study this news flow, and when they add it all up, their minds are going to blow. Still, it should also call into question why there's so much negativity in the financial media, and probably be compared to the period of so-called yellow journalism, because it's just too rigid. It's been too much this year, and so many people have been scared out of this market. But something else is happening, and you see this every day on the show. There's a different kind of stock market that most professional investors and money managers grew up with. This is not what they grew up with. It's not what they learned about in school. The concentration of gainers, right? It sort of has befuddled Wall Street, but it's not necessarily a new occurrence. This article, it's in The Economist this week, explains that many blue chip stocks are still, at this moment, like Verizon, trading below the global financial crisis levels. Now, some have rebounded, like Bank of America, which finally reached a new high. It only had to wait from 2006 to do it. So if you're looking at those kind of great values, you've missed out. Meanwhile, there have been hundreds of life-changing stock moves. I'm talking stocks that are up 2, 3, 4, 10,000%. But the experts ignore them because, well, it's not going to end well. That explains why there have been so many people, a record amount of folks right here. They're just leaving. They're just leaving actively managed funds, $600 billion this year. Now, while the financial media and the market mavens keep blowing the clarion horn of fear, publicly traded companies, they're far less fearful. Look at this fourth quarter guidance, right? So far, 56 firms have reported negative guidance. The average is 60. Now, here's the irony of all ironies. All these areas where you see red above green, that's where Wall Street says are the best opportunities, right? Guess which one is the worst? Guess which one you shouldn't buy? The one where the green is substantially higher than the red. Don't touch technology, folks. Even though those firms are saying things are going to be fabulous, the CEO is telling you that. Anyway, they all say that this sector is going to have a bad year. We'll see. So far, the companies are telling you that they're going to do well. Of course, there's also the notion that because retail investors are crushing the pros, that this is a period of irrational exuberance. Therefore, it's got to be a market top. Now, we do know that the laws of physics, listen, even the laws of everyday kids blowing bubbles mean that they have to get stretched before they can pop. So here's some of your traditional bubbles. The Japanese financial bubble, the year before it popped, up 164%. The European tech bubble, up 123%. Our tech bubble, up 104%. This has been a pretty pedestrian years, right? Tech is up 19%. Is that looking like a bubble that's going to pop? Does it look like hysteria to you? Now, I get it. Bubbles can be dangerous, but I say enjoy this ride while you can.